The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast. Please subscribe to this podcast so you're always going to have our latest version at your fingertips. And if you're enjoying these, feel free to please forward these links on to your friends and your family and your coworkers. Give them a chance to take a look at what we're doing here. We would appreciate that a great deal. Thank you.
So today we're going to talk about the consumer, the U.S. consumer. The United States consumer drives the world economy. We don't think of it that way because we go out spending money on take care of our household, but there is nobody in the world like the U.S. consumer when they have money to go shopping. We support the entire global economy one way or another. But if you're an investor on your own and you're kind of browsing YouTube and the internet and social media, you're running into articles that say the recession cannot be far away. The real estate mortgages are starting to go in the tank. We're seeing foreclosures increase on the real estate. You still see vacancies downtown galore and increasing in some cases. Unemployment is still, well, it's not so bad, but it's not so good either. Credit card debt is reaching new highs, and this can't keep up. And we've got car loans are going into default. Credit card defaults that banks are having to absorb is increasing. All of this is really scary news, and it's actually keeping many investors out of the market and has for more than a year. These things continue to attract attention. But what we want to show you today is actually things aren't so bad. They may not be the hottest economy we've ever had, but things are not so bad. All we have to do is start looking at retail sales and what's going on in our country's economy. Consumers are not on their backs.
Right,
They're
and that is
walking through the store door.
That is critical, especially in the U.S. economy. Consumer spending is a huge 70-ish piece of GDP. If consumers aren't spending, we almost have no chance of having a growing economy. We've got to have people out there with their money in motion. And right now we have that. But what's important, even if, say, credit card debt's getting near an all-time high as a percent of disposable income, it's actually down below pre-pandemic levels. So it's always important to get the context for these numbers, because you can get a statistic and paint a terrible picture about it if you want. But if you take a little broader view, how are we doing in total? Right now, the U.S. consumer is in a very, very strong position, and that bodes well for the U.S. economy in the coming years.
Well, the chart I just put up on the screen is actually retail sales. It's Redbook Research, same store sales. And we can see that if we go back into 22, we actually had much higher numbers. But think about what was happening here.
Right.
This was the COVID money that had been dumped in your pocketbook, and it's in your bank, and you're saying, "My goodness, look at how I've been blessed." Here is all this money. What am I going to do with this? I can't go to work. I have to stay home. Let's do something with it. So we spent money that we hadn't had. I mean, we're celebrating government largesse without regard to the fact that some way or someday we have to pay all that money back, because the government didn't have it. They printed it to keep us happy, locked down. But be that as it's kind of leveling out, we can see that a little bit of a level out here, but we're still here in really actually very strong. This is pre-COVID level. It's really consistent right in here back at 19, and here we are at 24. It moved up the latter part of 23. These are decent numbers.
Yep,
yeah, some stores are not doing well. Competition is what it is. The internet, what it is, changing the way people shop. You get drone delivery to your doorstep. I mean, it's not happening where I live, but it is in a lot of the metro areas.
Right.
I, drones are changing life for everybody. In fact, my wife showed me a picture last night. She was on Facebook and while we were in the kitchen, and she said, "Here, you got to see this." It was an eagle who had captured a drone in its claws and was carrying it off. So hopefully, if it had an Amazon package in it, it had already made the delivery.
But if it was food, it probably got eaten, but you're not going to get it. Yeah. So,
I'm sure it got destroyed.
yeah.
Anyway, the consumer's actually in decent shape. We have some problems, there's no doubt, and those will be the case all along. But if we move on here to this next chart, um, the other issue that's been scary is credit card debt.
Yeah.
There have been articles saying banks are having to absorb massive losses on delinquent credit cards. And there's no doubt that given inflation, some of the lower income segments in our economy are suffering. Times
Having
are
trouble.
hard when
Sure.
prices go up and wages don't keep up, and that's just the current environment we're in. So, yes, there are some delinquencies, there are some actual defaults, but as a percentage of what's household income, this is not out of line. In fact, it's better than it was back here in the teens. It dropped, well, after '08 and '09, people got really conservative. They lost a lot of money in real estate speculation, the market tanked. And when that happens, your sense of financial security diminishes, and you take a restock of what you're going to do and how you manage money. And so we became more conservative, and that shows here with credit card usage. COVID collapsed it, but it's increasing, but it's still below this longer term average from the 15s. So don't let those gurus in social media scare you that high credit card balances are a sign of a recession that is
Or
imminent.
that they're increasing rapidly. They're increasing rapidly off an all-time low. So they're still not back up to pre-pandemic levels. So we're doing okay there. It's not it's not as bad as a picture that can be painted if you look at the whole picture, doing pretty good.
So let's take a look at the next chart we have prepared here. Actually, we pulled it out of the article, and this is the mortgage rate because the real estate issue is a big issue. Real estate's a major driver of the economy.
Yeah.
We need consumers, and a good portion of consumption is buying a new house or an existing home. It's new to you. And once you move in there, you get settled, everything's unboxed and put away, and you look around and say, gee, the house is really nice. I'm glad we made this decision. But look at my recliner. Do you know how old my recliner is? Frankly, I'm one of those. My recliner is 40 years old. And
There
we're
you
now
go.
saying, we didn't just buy this house, we've been in it for over 20 years. But it's time for the recliner to go. That's part of the consumer keeping the economy alive because somebody's got to sell it and somebody's got to ship it and somebody's got to make it in the beginning and somebody's got to import materials probably for parts of it. So household ownership is a major driver of the economy, and houses haven't been turning over very often. And this chart basically explains why. When we had low interest rates during COVID, people who could refinance their debt as cheaply as they could get it. We have clients who have mortgages at 2.5%.
Sure.
They were Johnny on the spot when those low interest rates came. Amazon issued a ton of debt at about the same rate. I don't remember the exact rate, a little below or just above the 2.5%. They took out 30-year loan, billions of dollars, I know, well, hundreds of millions of dollars. Um, and I'm thinking, why are they doing that? Well, the reason they're doing that is they just bankrolled cash. They said at 2.5%, we make enough money at Amazon, we could afford to pay a 2.5%
That's it.
loan.
We'll need it sometime. Might as well borrow it now when it's dirt cheap. And people did that. For individuals, most of the time, that home mortgage, that's the most debt they'll ever accumulate. And that piece of real estate is the biggest investment that they're ever going to have. And when your acquisition rate is 4% cost, It doesn't take a whole lot of appreciation to do better than that. So that puts you in an extremely strong position going forward. And even, quite frankly, even if you're borrowing money today, if you're paying 7%, historically speaking, you're in a really good spot there. There's nothing wrong with that rate at all. You could have paid significantly more for that. In just take a look at the chart back there. 12% is no problem. You want higher, drop on back to the 70s. You'll see it. Um, but even at 7%, you're in a very, very good position going forward. And between the people that borrowed at 2 and 3% and the people still that can find a piece of real estate to buy at 6 and change and 7%, that's a very strong position to be in. That's a really good place to be.
So this chart doesn't go back far enough. Actually,
Right.
back in the early 80s, I had a client who called and said, I just qualified for this loan and I'm just not sure. We need, we got extra kids, we need more space. He said, so what's the deal? I said, well, we got a new house, we've got approved for the loan, and I just don't know if I should go ahead with it. I said, well, what's the interest rate? He says 21 and a half.
21 and a half.
21 and a half.
Wow.
Okay, but the issue was you qualified, you have the income, you can afford it, and you need the house. He bought the house, and what happened? The house value went up, and the interest rate came down. So he had a winning situation. He could continue to refinance at lower rates, or what would have been, it wasn't very popular at the time, was an adjustable rate loan. But the rates continued to adjust downward for 20 years.
Right.
And so we go back here. Look at this chart, Perry. You just mentioned going back to the 90s. Not the house I'm in now, but my prior house I bought here in 1990, and I paid 10 and 5/8 interest on the loan.
There you go.
Look, I needed the house. I mean, that worked. And then I bought another house here in '01, and I was over 6. I mean, I don't remember the exact rate, but it was more than 6. And
That's
when
good
the
rate.
rates came down, I refinanced.
There you go.
People are thinking 7% is absolutely irrational. We should not have to pay that much. But that's because of the recent hindsight bias of rates being
Sure.
so low, abnormally so, from external forces on our economy.
Absolutely.
That's not reality. The current market really is reality. And as people begin to adapt to that, we will see housing turnover begin. But if you're still in a 4% mortgage and you're going to go out and buy one at 6 or 7, those people aren't going to sell. That's going to keep inventory tight. That is a problem for us as far as, well, if you own a house, that's not a problem because that means your house price is probably not going to suffer a big decline like it did back in '08 and '09.
Correct.
But if you're buying a house and you're looking for prices to fall, I wouldn't count on that. They may
Not
dip
likely.
a bit depending upon the territory. Real estate's always location, location, location.
Sure.
So if you're in a place where people are moving out of town, there's probably a bargain to be had. But if you're in a place where employment is stable, the population is stable, prices aren't changing on the downside very much. At least I think the risk of that's fairly slim. And that supports the economy because people are still going to buy houses, or somebody's going to buy one as a rental. Either way, that supports the economy. Home builders have adjusted to this new reality. They actually, since the great financial meltdown in COVID, they had to make several adjustments along the way, and we're not through. I mean, the
Sure.
economy right now is always dynamic. We're going to see these things change. But the fear mongering that's going on in social media regarding the consumers on the verge of bankruptcy, nearly so, and a recession is bound to unfold as a result, probably a little overdone. Come back and do
Absolutely.
some research.
Yeah, we're looking at a consumer with disposable income that's increasing, debt levels that are decreasing, retail sales that are strong and increasing. Those are all really great signs for the U.S. economy, and that can hide a lot of problems. As long as consumers are out there with money in motion, our economy is going to be in fairly good shape for a baseline, no matter what. And that's a good place to be heading into 2025.
Well, and the only variable we haven't addressed is wages. And wages are always lagging. So as prices, inflation move, wages are a lagging asset or a data point, and that's going to come along. Over, probably we'll see more of that over this next year. We've seen that with union wage hikes. We've seen it with states raising minimum wage, which isn't necessarily good for labor, but it does put pressure on other employers to raise their base wages,
Sure.
and that will unfold in 25 and 26. So anyway, if this has been of interest to you, you probably have some friends, coworkers, or family members who might be interested also. We'd appreciate it if you'd share the link, send it along to them with a recommendation. Like us on our YouTube page. Go to our Facebook page and follow us on Facebook. That is, go to Facebook and go look for Investor Resources in Port Orchard, Washington. That's where our home office is currently located. And like us there, follow us. We appreciate your attention. And that way you'll be sure to know when we do our next updates. As for now, we're starting off in January. We wish you and your family a very happy and prosperous new year.